They tried to kill it. They threw everything they had at it. They raised margins to $25,000 per contract. They triggered the biggest single-day crash in modern history. They liquidated 67 million ounces of leveraged positions. They ran headlines on every financial network declaring the silver rally dead. They brought out every analyst, every talking head, every so-called expert to tell you that the top was in, that the bubble had popped, that you were a fool for buying silver at 80. They did everything in their power to break your conviction, to make you doubt, to make you sell. And what happened? What happened after the smoke cleared and the dust settled and the margin call liquidations finished? Silver bounced, not by a little, by almost $5 in a single session. As I speak to you right now, silver is trading at $7,550, and in Shanghai, in the physical market, that actually matters, silver is trading at $7,925s. Let that sink in. The paper price in New York says 75. The physical price in China says 79. The gap is widening. The decoupling is accelerating. And everything we have been telling you on this channel is being validated in real time. Ladies and gentlemen, Asian Guy here, and today we're going to break down exactly what happened in the last 48 hours. We are going to show you why Monday's crash was the final desperate gasp of a dying suppression scheme. We are going to connect the dots between silver, gold, Russia, Ukraine, Venezuela, Taiwan, and the complete restructuring of the global financial order. And most importantly, we are going to show you why this rebound is just the beginning. The squeeze is not over. The squeeze has entered a new phase. And the banks who bet against you are about to learn a very expensive lesson. Let me take you back to Monday, because what happened on Monday was not a natural market event. It was not organic selling. It was not profit-taking aching by rational investors. What happened on Monday was a coordinated assault on the precious metals market designed to shake out every weak hand, to trigger every stop loss, to create maximum psychological damage at the exact moment when the banks were facing annihilation. The numbers tell the story. Gold fell by one of the largest single-day amounts in its trading history. Silver got absolutely hammered. We saw the kind of waterfall decline that only happens when forced liquidations cascade through the futures market. The CME margin hike that went into effect over the weekend did exactly what it was designed to do. It caught thousands of leveraged traders off guard. It forced them to either post additional capital by Monday morning or watch their positions get liquidated automatically. And because this happened right after a holiday weekend, because the banks timed it perfectly for maximum chaos, the retail traders could not respond in time. Their positions were sold into a falling market. Their stop losses were triggered. And the banks, the same banks who have been short silver for the entire rally, were waiting on the other side with open arms to scoop up those contracts at a discount. This is not speculation. This is not conspiracy theory. This is how the market works. This is the playbook they have been running since 1980. Raise margins during a rally. Trigger force liquidations. Crash the price. Cover your short positions at lower prices. Rinse and repeat. They have done it so many times that they have become arrogant. They have become predictable. And this time, their arrogance is going to cost them everything. Because something happened on Tuesday that was not supposed to happen according to their models. Something happened that tells you the game has fundamentally changed. Silver bounced hard, fast, decisively. The mainstream financial media will tell you that Monday produced what technicians call a buying exhaustion tail. They will tell you that we saw a key reversal pattern on the daily chart. They will use fancy technical jargon to make it sound like the rally is over and the bears have taken control. But let me translate what actually happened for you. What actually happened is that the banks spent all of their ammunition on Monday. They fired every bullet they had. They created maximum fear. And the moment the selling stopped, the moment the forced liquidations were completed, buyers stepped in immediately. Not in a few days, not after a period of consolidation. Immediately, within hours of the bottom, silver was rallying. That is not what happens when a bubble pops. That is not what happens when a bull market ends. That is what happens when the fundamental demand is so overwhelming, so relentless, so insatiable, that even the most aggressive manipulation can only create temporary dips. Look at the numbers from today. February gold is up 70.30. That is a massive single-day gain. That is not dead cat bounce territory. That is aggressive buying. March silver is up $475, almost $5 in a single session. After one of the biggest crashes in history, the bears had their chance. They had complete control of the market for 24 hours. They had every advantage, and they could not hold the lows. They could not build on Monday's decline. They could not even come close to challenging the support levels that would signal a genuine trend change. The WAF market rating remains at 7.0 for both gold and silver. That means the underlying trend is still bullish. That means Monday was a correction within a bull market, not a reversal of a bull market. The technical damage that the bears needed to inflict did not happen. The support at 67.50 that would have confirmed a bearish breakdown was never even approached. The bulls are still in control, and the smart money knows it. But here is what the mainstream media will not tell you. Here's the part that should make every silver investor sit up and pay attention. While the paper price in New York crashed to $70 and change on Monday, the physical price in Shanghai barely flinched. As I speak right now, silver in China is trading at $79.25. That is almost $4 higher than the Kong's price. $4 on a commodity that is supposed to have one global price. On a commodity where arbitrage should eliminate any significant premium within minutes, but the arbitrage is not working. The physical market is not responding to the paper market signals. And that tells you everything you need to know about what is really happening. The paper market and the physical market are decoupling. We have been warning about this for months. We have been telling you that there is not enough physical silver to back all of the paper claims. We have been telling you that the 300-to-1 paper to physical ratio is unsustainable. We have been telling you that eventually the real market would assert itself over the fictional market. And now it is happening right in front of your eyes. China is paying $7,925 for silver right now. That is the real price. That is the price that industrial buyers, that sovereign wealth funds, that strategic reserve managers are paying for physical metal. The 75 tall 56 price in New York is the paper price. It is the price of promises. It is the price of contracts that may or may not be backed by actual metal. The gap between these two prices is the gap between fiction and reality. And that gap is going to widen until it cannot be ignored anymore. Think about what this means for the comics. Think about what this means for the banks who are short. They crashed the paper price by $7 on Monday. But the physical price only dropped by $3. That means the premium for physical silver over paper increased during the crash. That is the opposite of what should happen if the selling was real. That is the opposite of what should happen if the rally was truly exhausted. When genuine profit-taking happens, the physical premium compresses because demand is falling. When manipulation happens, the physical premium expands because the smart money recognizes the artificially low prices as a buying opportunity. The physical premium just expanded. The smart money is accumulating. The manipulation failed. Now, let me connect the dots between what is happening in the silver market and what is happening in the broader geopolitical landscape. Because these events are not isolated, these events are all symptoms of the same disease. The disease is the collapse of the post-World War II global order. The disease is the end of American hegemony. The disease is the transition from a unipolar world dominated by the dollar to a multipolar world where hard assets matter again. And every single headline in today's news confirms this thesis. Start with Russia and Ukraine. The peace initiative is facing a potential setback. President Trump has been trying to end the war to negotiate a settlement to bring stability back to Europe. But President Putin just threw a wrench into those plans. He is claiming that Ukrainian drones targeted his residence. He is saying that Russia will revise its negotiating position. He is using this as leverage, as a bargaining chip, as a way to extract more concessions from the West. Now, I'm not going to tell you who is right and who is wrong in this conflict. That is not the point. The point is that geopolitical instability is increasing, not decreasing. The point is that the dream of a quick peace deal and a return to normal is evaporating. And when geopolitical instability increases, when the world becomes more dangerous, when the rules-based international order continues to crumble, what happens to safe haven assets? They go up. Gold and silver are the ultimate safe haven assets. They have been for 5,000 years. And every time the world gets more chaotic, more uncertain, more dangerous, capital flows into precious metals. This is not speculation. This is history. This is human nature. When people are scared, they want something real. They want something that cannot be devalued by a central bank. They want something that will still have value when empires fall. That is gold. That is silver. Now, look at Venezuela. The United States just conducted military strikes inside a sovereign nation. President Trump confirmed that the U.S. military struck a dock facility in Venezuela. The CIA is conducting drone attacks on Venezuelan soil. This is not a trade war. This is not sanctions. This is kinetic military action against a country in our own hemisphere. And what does Venezuela have? Oil. Lots of oil. Some of the largest reserves in the world. The conflict with Venezuela is not really about drugs. It is about resources. It is about control. It is about who gets to access the strategic commodities that the modern economy depends on. And when you add this military escalation to the existing tensions with Russia, with China, with Iran, you start to see a pattern emerging. The world is fracturing. The global trade system that allowed cheap goods to flow freely across borders is breaking down. And in a world of resource nationalism, in a world of trade wars and hot wars and proxy wars, the countries and the investors who hold physical commodities will thrive. The countries and the investors who hold paper promises will suffer. And then there is Taiwan. This is the big one. This is the story that could change everything. China just conducted its most expansive military exercises in decades. They fired dozens of rockets into waters near Taiwan. They simulated a blockade of one of the world's busiest shipping lanes. They declared drill zones that cut into Taiwan's territorial waters for the first time since Nancy Pelosi's visit 3 years ago. They disrupted flights to Taiwan's offshore outposts. They are testing President Trump. They're testing American resolve. They're probing to see how far they can push before the United States responds. The exercises are called Justice Mission 2025. The name tells you everything about Beijing's intentions. They see Taiwan as unfinished business. They see reunification as a matter of justice, and they are willing to use military force to achieve it. Now, let me tell you what Taiwan means for the silver market. Taiwan produces over 90% of the world's most advanced semiconductors. Those semiconductors are in every piece of modern technology. They are in your phone, they are in your car, they are in military weapon systems. They are in the data centers that power the artificial intelligence revolution. If China blockades Taiwan, if they invade, if they even just create enough uncertainty to disrupt the supply chain, the impact on the global economy will be catastrophic. We are talking about a crisis that makes CO look like a minor inconvenience. We are talking about factories shutting down worldwide because they cannot get chips. We're talking about a global recession that could last years. And what is in those semiconductors? Silver. Every single chip uses silver. Every single solar panel uses silver. Every single electric vehicle uses silver. If the Taiwan supply chain breaks, the demand for silver does not go away. It gets more urgent. It gets more desperate. Countries will scramble to secure whatever silver they can to maintain their strategic industries. The price will not go down. The price will go to levels that nobody can currently imagine. This is why China is hoarding silver right now. This is why they restricted exports effective January. They know what is coming. They are preparing for a conflict that could reshape the entire global order. And they are making sure they have enough of the strategic metals to win that conflict. The Chinese foreign minister just gave a speech calling for better relations with the United States. He proposed a new paradigm of positive interaction, but in the same breath, he reiterated that China will not yield an inch on Taiwan. He reinforced Beijing's opposition to U.S. arms sales to Taiwan. He emphasized the importance of reunification. This is not the language of peace. This is the language of someone buying time. This is the language of someone who knows that conflict is inevitable, but wants to choose the timing. The diplomatic momentum may build through 2026. There may be visits by Trump to China and Xi to the United States. But the fundamental conflict over Taiwan has not been resolved. It cannot be resolved through diplomacy because both sides have irreconcilable positions. America will not abandon Taiwan. China will not accept Taiwanese independence. Something has to give, and when it does, the financial markets will experience a shock that makes Monday's crash look like a rounding error. So where does this leave us? It leaves us with a silver market that just survived the biggest coordinated attack in decades. It leaves us with a price that bounced immediately because the underlying demand is too strong to suppress. It leaves us with a physical premium in China that tells you the real price is almost $80, not $75. It leaves us with geopolitical tensions escalating in Europe, in South America, and in Asia. It leaves us with a dollar that is under assault from all directions. From BRICS, de-dollarization, from fiscal irresponsibility, from a Federal Reserve that is trapped between inflation and insolvency, every single factor points in the same direction. Every single data point confirms the bull thesis. The only thing that changed on Monday was that a bunch of leveraged traders got shaken out of their positions. The fundamentals did not change. The supply deficit did not change. The industrial demand did not change. The paper-to-physical ratio did not change. What changed was that the banks bought themselves a few more days to cover their shorts at lower prices. And even that is not working because the price is already recovering. Let me give you the technical picture because this matters for understanding what comes next. The bears needed to produce follow rough selling on Tuesday. They needed to build on Monday's decline. They needed to push prices below the support levels that would confirm a trend change. They failed on every count. First resistance for silver is at 75 wars, and we are already above that at 75.56. Next resistance is at 76ers. Support is at 74 dwellers, and then 73 during orders. The bull's upside objective is closing prices above Monday is record high of $826. The bear's downside objective is closing prices below $69.50. Look at where we are. We are much closer to challenging the record high than we are to breaking critical support. The path of least resistance is still up. The trend is still your friend, and the banks are still underwater on their short positions. For gold, the picture is even more bullish. February gold is trading at 4,350s, up over $70 on the day. The bull's next objective is the contract and record high of $484. The bears need to push prices below $4,200 to do any real damage. We are nowhere close to that level. Gold is acting as the anchor for the entire precious metals complex. When gold is strong, silver follows. When gold is hitting all-time highs, silver becomes the leveraged play that outperforms. The gold to silver ratio has been compressing, which means silver has been outperforming gold on a relative basis. This is what happens in the late stages of a precious metals bull market. This is what happened in 1980. This is what happened in 2011. Silver catches up to gold and then overtakes it in percentage terms. We are watching that process play out right now. The key outside markets are also supportive. The dollar index is only slightly up, which means there is no major headwind from currency strength. Crude oil is up, trading around 58.50, which tells you that inflationary pressures are still present in the commodity complex. The 10-year Treasury yield is at 4.12%, which is high enough to signal ongoing inflation concerns, but not high enough to indicate the Fed is about to aggressively tighten. The macro environment remains supportive for precious metals. The safe haven bid is intact, and the technical damage that the bears needed to inflict simply did not happen. Now, I want to talk directly to those of you who sold on Monday, to those of you who got scared, to those of you who looked at the red on your screen and panicked. I am not here to mock you. I'm not here to say I told you so. I am here to give you perspective. What you experienced on Monday was designed to make you feel that way. It was engineered by professionals who have spent billions of dollars developing algorithms and trading strategies specifically to exploit human psychology. They know that when prices crash, people panic. They know that when the headlines turn negative, people doubt their thesis. They use the margin hike as the trigger. They used the holiday weekend as cover. They used every tool at their disposal to make you believe that the rally was over. And many of you fell for it. You're not stupid. You are human. But now you have a choice. You can let that experience define your behavior going forward. Selling every dip, doubting every rally, always one step behind the market, or you can learn from it. You can recognize the pattern. You can understand that volatility is the price you pay for participating in a generational bull market. And you can position yourself to profit from the next leg higher instead of being shaken out again. The people who sold on Monday are going to watch silver rally back to 80. They are going to watch it make new highs. They are going to feel the regret that comes from selling the bottom. And many of them will not be able to bring themselves to buy back at higher prices. They will tell themselves that they will wait for another dip. And when that dip comes, they will be too scared to buy because they remember how the last dip felt. This is the psychological trap that keeps retail investors poor. They buy high because they are excited. They sell low because they are scared. And the wealth transfers from them to the institutions who have the discipline and the conviction to do the opposite. Do not be one of those people. Understand what is happening here. Understand that the manipulation is a feature, not a bug. Understand that the volatility is what creates the opportunity. If silver went up in a straight line every day, everyone would own it and the gains would be minimal. It is precisely because the path is difficult, because the banks attack the price. Because there are crashes like Monday that the eventual gains are so substantial. The price of admission to a 10x return is the emotional fortitude to hold through 50% drawdowns. That is the deal. That is the trade. And if you cannot handle that trade, you should not be in this market. But if you can handle it, if you can zoom out and see the bigger picture, if you can understand that Monday was just noise and a multi-year signal, then you're going to be rewarded beyond your imagination. The physical market is telling you the truth. $79.25 in China, that is the real price. That is what industrial buyers are paying right now for metal they need to run their factories. The paper market in New York is a fiction. It is a shadow on the wall. It can be manipulated in the short term through margin hikes and algorithmic trading and coordinated selling. But it cannot be manipulated forever because eventually the buyers of physical metal stop accepting the paper price. They demand premiums. They take delivery. They drain the vaults. And when the vaults are empty, the paper price has to converge to the physical price or the exchange defaults. We are in the end game of that process. The vaults are already at historic lows. The delivery demands are already at record levels. The premium in Shanghai is already telling you that the COMEX price is too low. All that remains is for the market to recognize what is already obvious to anyone paying attention. The $5 rebound today is the market recognizing it. The $70 rebound in gold is the market recognizing it. The failed follow-through selling is the market recognizing it. The banks can delay the inevitable, but they cannot prevent it. They can create scary headlines, but they cannot create physical silver. They can raise margins to $50,000 per contract, but they cannot margin call the earth. The ore bodies are depleted. The mines are running at capacity. The refineries are maxed out. And the demand is growing exponentially from solar, from electric vehicles, from electronics, from medical devices, from strategic reserves. The supply-demand equation has only one solution, and that solution is dramatically higher prices. So what happens from here? In the short term, expect more volatility. The banks are wounded, not dead. They will try again. They will look for any excuse to smash the price. They will use geopolitical headlines, economic data, technical patterns, anything they can find to justify another attack. But each attack will be less effective than the last. Each recovery will be faster. Each new high will be more convincing. The trend is in place. The fundamentals are in place. The only variable is how long it takes for the price to reflect reality. My expectation is that we retest the recent highs within days, not weeks. The buying on this dip has been too aggressive to suggest that the rally is over. The failure of the bears to produce follow-rough selling suggests that there are no real sellers left, only forced sellers who have already been liquidated. The path to $80 is now clear. The path to 8,207, the record high, is achievable before the end of the week. And if we break through that level on strong volume, the next target is $90 and then $100. These are not fantasy numbers. These are the mathematical implications of a market where physical demand exceeds physical supply by orders of magnitude. The Russia-Ukraine situation is not going to stabilize anytime soon. Putin is playing games. Zelensky is digging in. The peace process is stalling. This means continued safe haven demand for precious metals. The Venezuela situation is escalating. Military strikes inside a sovereign nation are not the actions of a country seeking de-escalation. This means continued geopolitical risk, continued demand for assets that cannot be frozen or sanctioned. The Taiwan situation is the most dangerous of all. China is preparing for something. The scale of these military exercises tells you that this is not just posturing. This is rehearsal. And when the curtain rises on the main event, the financial markets will experience a dislocation that makes every previous crisis look minor. You have a window of opportunity right now. The price is $7,550. The premium in China says it should be $79 an hour. The fundamentals say it should be much higher than that. Monday's crash gave you a gift. It gave you a chance to buy at lower prices. It gave you a chance to add to your position. It gave you a chance to average down if you bought higher. Do not waste that gift. Do not let the fear of another dip paralyze you. Understand that the dips are temporary and the trend is permanent. Understand that the banks are running out of ammunition while the physical buyers are just getting started. Understand that you are on the right side of history. The world is changing. The dollar-based financial system is crumbling. The countries that hold hard assets are ascending. While the countries that rely on paper promises are declining, you have a choice to make. You can hold dollars that are being printed into oblivion to bail out banks and fund wars. Or you can hold silver, an asset that is essential to the modern economy, that cannot be printed, that is in a structural deficit, and that is being accumulated by every smart player on the planet. The choice should be obvious. The only question is whether you have the courage to make it. Monday was a test. It was a test of your conviction. It was a test of your understanding. It was a test of your ability to see through the manipulation and recognize the underlying truth. Many people failed that test. They sold at the worst possible moment. They let the banks win. But you do not have to be one of them. You can use this moment to strengthen your position. You can use this moment to recommit to your thesis. You can use this moment to buy more, to hold tighter, to prepare for what is coming. The silver squeeze is not over. The silver squeeze just passed its first major stress test. The price crashed and immediately recovered. The paper price diverged from the physical price, and the physical price held. The banks fired their biggest weapon, and it only worked for 24 hours. This is not a market that is about to collapse. This is a market that is consolidating for the next leg higher. This is a market where the sellers are exhausted and the buyers are waiting. This is a market that is going to make its holders very, very wealthy. I am Asian Guy, and the battle for real money continues. Monday was their best shot. It was not enough. The rebound is here. The squeeze is alive, and the path to $100 is more certain than ever. Remember to like, subscribe, and share the video.